Good Friday afternoon, everyone. My name is Hilda Kennedy, and I am president of AmPac Business Capital. And we really want to thank our valued clients for joining the webinar. We're going to begin in another minute or so. But if you chose to be here on Friday afternoon for this great opportunity for you to finish strong and hear about the greatest resources from some of the best speakers in the industry on topics to help you finish strong, then you are in the right place at the right time. So thank you very much. We'll be starting in another minute. This session, as you know, is being recorded, and we will have it on the AmPac YouTube channel. If you have questions already that you came in with, please don't hesitate to use the Q&A feature at the bottom of your screen so that we can get those questions. We are going to answer them in writing. Some of them we might call out and answer live so that everyone gets those. So we'll start in another minute or so. It is 3 o'clock. We see several participants on. We had a few more registrations, so we'll start in about 1 minute. On your discussion today, you have a member of the SBDC team, one of the lead finance center consultants, Craig Russum, and we also have Elsie Barrios from Wilson Ivanova CPA firm here in the Inland Empire on, and then you have members of the AmPac team, Janine Warren, who's the Executive VP of Business Development, Sales and Marketing, and Janine Peltier, a Business Development Officer, and Brian Kennedy, who's our Ecosystem Director and Webinar Master. And I am serving as your host, Hilda Kennedy, founder and president of AmPac Business Capital. So again, thank you very much for being here. We're going to now share our screen, and I'll tell you a little bit about the agenda that we have for you this afternoon and the learning opportunities and objectives that we have for you. Again, today we're talking about finishing strong in 2021, and these programs, which are not so new, but underutilized. We thought it's so important for us to get this out in webinar format to our clients to make sure that you can take advantage of it. So we're going to talk about the SBA 504 refinance program and the third-party lender refinance program that's available from SBA to our small business clients who have the SBA 504 loan, or you may have some other SBA loans. Changes have been made to this program. Not everyone is taking advantage of it. We've sent out some notices regarding this, but we want to make sure that you have the opportunity to hear some of the critical and exciting components of the program in case it can help you and your business and position you for further growth in 2022. So Janine Warren will be presenting on that. And then there's some exciting tax credit for small businesses that you can take advantage of before the end of the year. And we want to make sure that you get the latest information on that. So again, we're delighted to partner with Elsie Barrios, who's a CPA and supervisor at Wilson Ivanova CPAs here in the Inland Empire. And then this economic injury disaster loan. Some of you, our clients, have gotten the EIDL loan. You got it the first time around. Some of you were in the process when they reduced the amount available to $150,000 and you didn't get your maximum potential. Some of you didn't get in the window. And now there's an exciting opportunity for you to take advantage of the economic injury disaster loan. We are going to spend the bulk of our time giving Craig Russum, the lead finance center consultant for the SBDC Orange County Inland Empire. We want him to have the most time to tell you about this exciting product that will help you to be able to grow and expand. And so with that, I'm going to turn this over to Janine Warren, to talk about the 504 refinance program and the third-party lender refinance that we hope will benefit you and your business. Janine?
Good afternoon. So the SBA recently made some changes to include additional types of debt that can be refinanced into the low fixed rates of the 504 program, which is really an exciting opportunity.
Janine, your mic is a little muffled. I'm going to ask you to lean in a little bit and let's see if that's going to make it better.
Is that better?
I believe it is.
Okay.
And if you, our participants, can't hear, would you just shoot a note in questions? But that is better, Janine. I just want to make sure everyone can hear you.
Okay, I'll try turning my volume up. Okay. So why would you choose 504 refinance today? So to refinance the existing debt on your owner user commercial property provides you an opportunity right now to improve your cash flow. Perhaps it's been impacted by COVID-19. You can refinance your loan into a low fixed rate and potentially take cash out of that to help you with your cash flow. The change was that we used to only be able to look at loans that have been in place for 2 years or more. We can now look at eligible loans that have been in place for 6 months or less or more. So that's a really good benefit to that. Again, as we mentioned, it does allow a business to take cash out of the equity in your property to be used for your operating expenses. It's not used for capital expenditures, but to be used for almost anything that would show up on your P&L as an operating expense, such as your salaries and wages, your inventories, your materials purchases, your utilities, rent, and again, you want to hire new employees as well to be used for that. And maybe you run out of your PPP loans and you can tap into the equity of your building to help you with paying those employees and retaining them. So,
well, Janine, let me pause for just a moment. I'm sorry. We did get a note that it was a little difficult to hear. I'm getting a little bit of feedback. Can everyone, presenters, can you hear okay, or is it a little muffled for you? It's a bit muffled. Okay.
I don't know what to do.
Okay, let me do this. If you can hear me okay, I'm going to start. I'll take over from there, and Janine, you can be on questions and answer those if you would. So what Janine was talking about, one of the benefits of the 504 refinance program, is that it allows you to take cash out for equity for your business operating expenses, to pay down business lines of credit, and it allows you to retain employees because maybe PPP funds have run out, or we assume they've run out, and now you still have an opportunity because you finance your building to be able to use the equity in your building to pull cash out to continue to cover some of those operating expenses. 504 refinance has a higher loan to value than traditional conventional financing that sometimes lands at 65 to 70%, and therefore you would be able to pull more cash out. The 504 refinance allows you to go up to 90% loan to value for just a straight refinance of your loan, and today's refinance rate is 2.97% fixed for 25 years. If you pull cash out for those eligible business expenses that we talked about earlier, the loan to value is 85%. So again, a benefit for you as a small business owner in trying to pull cash out for operating cash to continue to grow, to expand into new products, to buy inventory, to really try and get ahead given all these shortages that we're seeing with, what's happening in the ports and so on. The 504 refinance can also, and this is one component of the program that we believe can really help small businesses. It can be used to refinance SBA 7A loans, SBA 504 loans, so your existing 504 loans, and any conventional hard money private and seller carry notes with these low long-term fixed rates. On the SBA 7A loans, if you have a 7A loan that you use to buy a building and you're in a you're facing a reset, or maybe you've pledged additional collateral, which is often required with the 7A loan, and you want to be able to get out of that in order to free up that collateral and just focus on the building that you finance, the SBA 504 refinance is a really great tool for that. And of course, for those of you who are our existing 504 clients, you know that blended long-term rate really gives you additional cash so that you can continue to grow your business. What we're able to do as your SBA AmPac partner and mission-based lender is, if you want to look at other options in terms of banking partners or support, we can try and help you get to the right partner to find the right fit for your business. This was as of the refinance rates on the SBA second, I think I quoted the wrong number, is 2.29%, 2.292, I said 97% fixed for 25 years. So it's a really good program and a good program for you to explore, and we'd happy to talk further about that. On refinancing of existing government debt, what we want to emphasize here is that it's only to help you benefit as a small business owner. It's not to refinance just to refinance. And so we have to do a test that if we're refinancing your 504 loan, or if we're refinancing a 7A loan that you use to purchase a building, then you have to show a minimum, or we have to document a minimum of 10% savings on the new payment amount, specifically attributed to the debt that's being refinanced. If you're pulling out additional cash because you can pull that cash out, we don't have to count that additional cash into the 10% savings, but dollar for dollar on what you're paying now for the existing debt and what you pay if with the refinance, we'll do that calculation for you to make sure that makes sense. One thing that we have to do in that calculation is SBA 504 loans do have a prepayment penalty. And as you know, it declines each year. When we're calculating the refinance savings, we're making sure that we include prepayment penalties, any financing fees or other financing costs to ensure that the benefit is to you, the small business, with at least 10% savings on the new payment. And if you'd like for us to do that, we'd be more than happy to do so. Just let us know. Janine Peltier on our team has been really taking the lead to help clients do that comparison and looking at those numbers to ensure that it makes sense for you. The next slide, please. What we wanted to show in this slide is just an example of what that might look like, a cash out refinance. So here we have, when we're doing these, it starts with the appraised value. We have to look at the appraised value of the building or fixed asset that we're refinancing. So in this example, the appraised value is $1.5 million, and the client is looking to refinance an existing 7A loan that's at $1 million. It's an existing 7A loan that we have determined was used for a fixed asset. They used it to purchase a building. So in looking at this example, their existing equity is $225,000. They're refinancing existing debt of $1 million, as we noted. And then they have the cash out option for eligible business expenses of $275,000. How did we come up with that number? Well, the cash out maximum for eligible business expenses is 20% of the appraised value.1 they can't go over 85% or the maximum 85% loan to value, which is $1,275,000 based on the appraised value. So that's $1,005,000 times 0.85 to give us this amount. So their cash out available is $275,000 or 18.3% for a total project cost of $1,005,000. So in refinancing this existing 7A plus pulling cash out, they'd get a bank loan of $675,000, an SBA 504 loan of $600,000, and then their equity, which is already in the building, is $225,000 to get to $1,005,000. And therefore they can refinance that 7A loan into the fixed 25-year SBA second trustee. They can also pull cash out for the working capital, $275,000. Next slide. In this case study, this is an existing 504 client who wants to refinance some existing debt, and their building has appreciated significantly. So their appraised value on the building is $5 million. They have existing debt on their first trust deed with the third-party lender of $2 million. And then they have their existing 504 loan, that's $1,005,000. So they have existing equity in the building of $750,000. They're trying to refinance $3.5 million. That's the bank first and the SBA second. And they want to pull cash out for eligible business expenses, $750,000. How do we get there? Their total financing, the max 85%, because they want to pull cash out, is based on the as-is appraised value of $5 million times 0.85 to give them $4,250,000. The cash out max is 20% loan to value, but based on the 85% loan to value, they can pull $750,000 or 15% in terms of cash out. So now you have a project structure total of $5 million and the third party loan of $2,250,000, 45% of the total amount. The SBA 504 at $2 million. And then the borrower contribution or the equity of $750,000 or 15% for that total $5 million. So they're able to retire or refinance those two debts, the first and the second SBA and the first loan, and then they're able to pull out the $750,000 in cash for business operations. So here we'll talk a little bit about this program, the temporary third-party lender or first trust deed refinance program. And this will be in place through December 27, 2021. So if we have a small business owner, next slide, who wants to leave their second trust deed in place, but they want to refinance their first trust deed and they want to pull cash out. Prior to the Economic Relief Aid Act, a small business owner could not pull cash out of the first trust deed. They could refinance the first trust deed, but if they had additional equity that had appreciated, they couldn't pull cash out. Because of the Economic Relief Aid, they can do that on a temporary basis. So in this example, the small business owner has a $500,000 first trust deed. They have an SBA second trustee. This was in the original loan. And then they had a contribution of $100,000 for $1 million project and $1 million appraised value. 5 years later, that building has appreciated and they paid down some debt. And so now they're at $420,000 on the first, $340,000 on the second, and the building has appreciated to $1.2 million. So they can pull cash out on the first trust deed, leaving the second trust deed in place, up to 90% loan to value or $320,000. So you can see now they can, their new first trust deed is $740,000. The second trust deed is $340,000, and they have $120,000 in equity. That's available to you. Sometimes the banks have to be educated on this program, and we're happy to work with you to try and get that from the bank. Our role in this is that we just subordinate to the new first trust deed. So the first trust deed lender does have to be in touch with us, your CDC. Next slide. Now we're going to talk about the tax credit for small businesses, and I will turn it over to Elsie. Remember, if you have any questions, please don't hesitate to use the Q&A feature. We'd be happy to answer. I know you're waiting to get to the main event of EIDL, but these tax credits are really beneficial. And so Elsie, I'll turn it over to you. Elsie, you're on mute, so come on off of mute so we can hear you talking.
There we go. Thank you, Hilda. My name is Elsie Barrios, and I'm from Wilson Ivanova CPAs. And today I'll be speaking about the Employee Retention Tax Credit, known as the ERTC, and how you can qualify in 2020 and 2021. Next slide, please. 2020 rules. There are 2 ways to qualify: the gross receipts test, the shutdown provision test as well. Next slide. The gross receipts test. If you can prove that a decrease in gross receipts over 50% compared to the same quarter in 2020 versus 2019, and the business qualifies under the gross receipts test and continues to qualify until the quarter in which it's restored to 80% of what they were in the same quarter in 2019. So you can keep qualifying until you meet the 80% receipts test. Next slide, please. Shutdown qualification. So this is another criteria that you can qualify under if you don't meet the gross receipts test. A business must be shut down by government order. This includes local orders, county orders, state orders, or federal orders. If a business was not shut down, but its supplies were shut down, it can qualify based on facts and circumstances, but an analysis would need to be made to make the determination. If a business operates in multiple locations and one of the locations had to be partially shut down or fully shut down, all locations qualify. So the entire business qualifies. Next slide. So there has been changes. So in this slide, I will talk about the 2021 changes. The employee retention tax credit is extended to December 31st, 2021, as we know now. I know there were some talks about ending at September 30th, 2021, but as of now, it's still continuing until fourth quarter. The credit is 70% of wages paid up to $10,000 of wages per employee per quarter. In 2020, the credit was 50% of wages paid up to $10,000 per employee. So yeah, so each quarter an employee can be paid up to $10,000 and qualify up to 70% for that credit, and that's only for 2021. The gross receipts test has changed to 20% to show a 20% decrease instead of a 50% decrease comparing to 2021 versus 2019. And also there is a look back quarter, meaning if you no longer qualify for under one quarter, if you qualified under the prior quarter, you still qualify for that one particular quarter. For example, if you don't qualify under Q2, but qualified under Q1 because you met the gross receipts test, you can still qualify in Q2. That's known as a look back quarter. Another thing is that the employee count increased from 100 to 500 employees, and meaning that all their wages qualify. And none of this is retroactive. It all started January 1st, 2021. Next slide, please. So there's been, we missed one slide, but there's been updates to the ERTC throughout the year. And one of the updates that we received in August was more guidance on the shareholder wages. Wages paid to shareholders of a corporation generally will not count unless the shareholder has no living relatives. Kind of strange. I know there's going to be some more talk about that, but currently that's what our guidance is from IRS. Also, if family members are on payroll that are related to the shareholder, their wages will not qualify for the ERTC. Another item that came about was that PP forgiveness, taxes and income are not part of the gross receipts test. So I know in 2021 and 2020, you're going to see a lot of forgiven loans, but that income does not qualify for part of the gross receipts test. And another great opportunity for businesses that just started in February of 2020 is starting in Q3 and Q4 of 2021. If you started a business in February 15, 2020, you can claim the ERTC up to 50,000 of the credit per quarter, and the business does not need to show a shutdown or revenue decline to qualify. They just have to be under the 1 million and gross receipts. So for new businesses out there, this is a great opportunity if you started within that time frame to take advantage of the ERTC credit. And with that, I think that's my part. I will turn it over to Craig Russell to speak.
Elsie, thank you. Hello to everyone. Thank you so much. Listen, folks, if you have W-2 wages that you're paying, you need to be paying attention to that program. Very little known IRS program that's run through your 940, 941 statements. Please call Elsie and talk through it and figure it out. I have clients that are outpacing their PPP. It's real and it needs to be part of your strategy, especially before you file your PPP round 2 forgiveness, okay? Because it's all related. Okay, we want to make sure that we're maximizing the wages that you pay for retention credit and maximize the forgiveness side of it as well. And so there's a lot of strategy play there. You can look back to 2020 still. I think you have up to 3 years or so to amend, right? So you can still look at 2020 and amend. $5,000 per employee for 2020 and $7,000 per employee per quarter for 2021. $28,000 for wages that you're paying out. It's real. It needs to be part of your strategy for 21 and looking back into 2020. So I can't stress it enough.
And Craig, before you start,
Yes.
I'll just say, Jim, we see your question, and Elsie, if you could look at that in the Q&A, and she'll make sure she answers that question for you. And then at the end, we will get everyone's contact information up, and we'll be sending that also out to everyone at the conclusion or following the webinar. We'll send you everyone's contact so that you can have them and be able to ask more questions. Thank you. Very good questions. On to you, Craig. Thank you.
Yep. No, thank you. So yeah, there was a change in that. I don't know if Elsie wants to address it. There was you can have both. The reality is you can have both, but you have to take out the wages that were paid with PPP funds. So that's why you have to pay attention to, which bucket of cash in essence that you were using to pay your wages. Those that were paid out of pocket and could be eligible for retention credit. The PPP side, you just had to understand where those wages were paid. Anything to add?
Right.
So, but great. I think I'm sharing. Am I good? Let's see. Let's see. I think I'm sharing my screen. Am I good to go?
You're on the screen. You've
Perfect.
got it.
Thank you.
Yeah.
Good afternoon, everyone. Happy Friday. Here we are. Gosh, December, or not December. Goodness, thank goodness, not yet. We still have Halloween to celebrate yet. But October, good 18 months into all of this. My name is Craig Russum. I'm with the Orange County Inland Empire SBDC, the Small Business Development Center. We have 9 different centers throughout Orange County Inland Empire here to serve you. If you learn nothing from me, I hope you just understand that we are here to serve you. All of our fees are covered with our relationship with the SBA, state and local federal tax dollars. So the state of California through GoBiz, Cal State Fullerton, their nonprofit grant, pays our bills. We have 150 consultants that are here for you to support you in your business. We've been around, gosh, I think 30 years. So this was, pre-COVID pandemic times and stuff. We were here to support you as business owners. And because of COVID and our relationship with the SBA, that's ultimately how I got involved in my finance team as boots on the ground with the EIDL program, the Economic Injury Disaster Loan. Gosh, I think I've been tasked on 300 plus webinars on the subject. I'm here as a resource, so please use Q&A. Anything that's directly related to you that you have questions on, I'll be sure to get my contact information to you. You're welcome to reach out to me one-on-one as well. Again, all my fees are covered, so take advantage of us. I think I already went through all that. That's me, some headshot. I'm in the finance sector. I'm a small business owner. I come from specialty sporting goods back in the late 90s, early 2000s. So I get you, I understand you, as business owners. And I just happen to love finance. And that's where my team comes in to help understand your business a little bit more by the numbers, P&L balance sheet, cash flow, debt financing. And really that's where we came into on the economic injury disaster loan. It's, quite frankly, I'm a licensed broker since 2006. I mean, it's the best business loan that I've ever seen. What is it? It's a 30-year loan at 3.75%. And let me get to the fact sheet. So they just published a brand new fact sheet here. So I want to share with you where all that is coming from. Here we go. And where am I getting all this information? Directly from the SBA. This program has changed so much over the last 18 months that, even myself, when I'm preparing for webinars and trying to give out the information, I'm always going back to the SBA's website first to see what kind of information has been published, sba.gov. Okay, it's a great place to start if you're trying to get more information, PPP, EIDL, other types of programs. We talked about 504, 7A, all of those types of programs through the SBA. Click on Get Help. And here we are. Here's all these programs that we've been talking about. Okay, and today we're going to talk mostly about the economic injury disaster loan and is it still available? How can I access it? There's been a lot of changes, a lot of rule changes that have been implemented. Yes, it is still open. It's actually an old program. It's supposed to be that tornado in Tennessee that wipes out a building, and so they're looking to rebuild. That's where this program started from. They tweaked it and turned it into an economic injury disaster. In essence, we got shut down March 15th, our businesses, our revenue. And so this was a way for them to use an existing program, tweak it a little bit, and then allow folks to come and apply from an economic injury standpoint. The criteria being that you needed to have 2019 revenue. Okay, so unfortunately, it wasn't forward thinking for folks that maybe came in late 2019, early 2020. You didn't have any top line revenue. The program wasn't available to you. As of today, it is. It's based on 2019 tax returns. Way back in March and April 2020, it wasn't. We were hopeful that you had those numbers, the top line gross receipts and your cost of goods, but you didn't have to have your tax return. Today you do. So if you're going to be new to the economic injury disaster loan and apply directly with the Fed, there's no brokers involved. You don't have to pay anybody to do it. There's no fees. 24-month deferral on the first payment. And that's also retroactive to people that might have been funded last year or even this year. There was a small window where it was only 18 months and they decided to push everyone to 24 months. But if you're new to the program, this is where you would apply. COVID-19 relief, .sba.gov. It's direct from the Fed. It's about a 20-minute application or so to get through it. A lot of Q&A. Take your time, folks. The biggest issues that we've had, mistakes that were made on the application, you're no longer going to be in an automated process. Okay, you're going to get kicked out. You're going to go towards some manual underwriting process that you're going to sit with 600,000 other people trying to get through that process. So I implore you to take your time, read through the questions. Most of these are just yes and no questions about you, your business. Answer truthfully, take your time with it. Some of them are disqualifiers. You may not understand which ones are and which ones are not, but I mean, that's just part of the application process and working through it. I'll tell you one I'll give you a hint. Unfortunately, we can't be selling marijuana and other related Fed items and businesses that the Fed deems as illegal. Even though here in California, it's an unfortunate side effect of being a Fed program that if you're selling recreational medical marijuana, so if you will be disqualified from the program. If you go to the EIDL page itself from here, when you click on it, and I'm sorry, I go super fast. I got like 4 hours worth of content to try and work through. So just know you can get a hold of me directly and we can talk through your current situation and try and help you through it. In the EIDL page, there is the EIDL itself, the EIDL Advance Program. So this is actually a grant program, which we'll talk about here in a moment. And then some data that if you're curious about where it's funding, who's been funding. California is the most, as you would expect. 3.75% 30-year amortization on this loan, unheard of. It's not tied to your lease. It's not tied to the usual type of business assets that what we think about with a business loan. It's unique in that way. There are certain funding amounts which change the rules a little bit, so you got to be careful or understand what they are. Loans under $25,000 are considered micro loans. Okay, and so there's no collateral requirement there. There's no UCC filing. There's no ability to repay component to it. There is a credit check though of I think it's down to 570 now. They keep moving it down. It started at 650 April 2020. At this point now we're at a 570 credit score for the loan amounts under, gosh, I think even 500,000, which is again unheard of. A credit score of 570 for a $500,000 business loan through the Fed. 25,000 and under, okay, again, no UCC filing, no ability to repay check. There is a credit check on it. It's straight to your bank account with a 24-month deferment before your first payment. Okay, what does that mean to you from a strategy standpoint? Let's just look at 25,000 if you were to defer it. So originally there were 12-month deferrals because it does accrue interest daily from funding. So the way I saw it from a strategy perspective, given still the uncertainty with COVID, I see it as a 3.75% insurance policy, quite honestly. You can take the EIDL funds, you can put it in a business interest-bearing account. There's no timeline in which to spend it. There are some restrictions in how you can spend it, which we'll go through here in a minute. But this gives you some idea of what it looks like. A 15,000, or I'm sorry, this should be 25. Let's change this so that it's comparable. About $130 a month. Now, I don't want you to pay on this thing for 30 years, that's for sure. So we got to have a plan in place about how to really utilize the funds, which is more important to me, right? From cash flow. I'm talking cash flow here. But to have access for 25 grand for $130 a month, it can do amazing things to help you with refinancing your existing business debt. So that's something that we can do. We talked about the 504 and the 7A today. Well, guess what? I can use the EIDL funds to actually make those structured payments. If I have existing business credit card debt, I can use the EIDL to pay that. Okay, so I can move kind of higher interest rate, short-term debt. You know, unfortunately, I know some of you were taking out some of those short-term, you know, high interest rate, very expensive loans to try and get through COVID and your pivot and everything else that you're trying to do. Maybe you're waiting for the EIDL. You know, unfortunately, I've got folks who are 12 months into this program when they're still trying to get through. So I get it. I understand that part. And then hopefully once you get funding, now I can use the EIDL to pay those off. I can pay my vendors. I can pay my business taxes. I can pay, you know, legal fees. I can pay rent, payroll, really anything that I see on a profit and loss statement is typically eligible. What I can't do with the economic injury funds, yes, ma'am.
Craig, I just want to just pause to just ask one quick question because you said it.
Go
quick,
right ahead.
I've heard some confusion around this question on, can I use my EIDL funds to pay my first trustee on my 504 and my second trustee on my 504, my regular monthly payment? And the answer is
yes.
And can I use the EIDL loan to pay my monthly payment on my SBA 7A loan?
Yes, everything I've seen, yes. And that was a recent change. So this was a clarification in the rules, folks. So this was that, you know, we've been straddling this for 18 months from anybody who comes from, you know, the debt world or, you know, who likes numbers. I mean, we saw it an immediate need. I mean, what are we trying to do here? We're trying to help folks with cash flow. We're trying to help them with their business and survive and then implement some sort of a pivot or a plan. And yet I can't refinance or use the funds to pay this high interest rate debt. Like, it didn't make a lot of sense to us. And so we knew we could use it in certain ways. And then just recently, a month or so ago, not even that long ago, they finally made a clarification of use of funds. So yes, we can make structured payments on Fed debt as well. So 504, 7A, stuff. So all those types of payments. So it can help you. Now, I like to refinance myself on the 504, though. I mean, that is an amazing opportunity that's become available as well. Because again, you're talking about structured debt over a longer term. You know, you can structure a short-term 7A into something like, you know, a new structured 504 over 25 years or something. Like, it's amazing how we can try and do this and how it can improve your cash flow. Well, the EIDL should be part of that conversation as far as how I'm going to use it short-term, long-term. I don't have, again, what's really unique, right? There's no timeline in which to spend the EIDL funds. Okay. Right. So I can think, you know, long-term with this. And as long as I have, so one restriction, right? I'll talk about one restriction, expansion. So what the SBA is saying.
It's great, Craig, that you're going down this road of expansion, because a question came in the chat. Well, why do I need a 504 when I can get an EIDL? And you're going to hit on that.
Yeah.
And then when you hit on that, also hit on to comfort the bank. If this borrower gets an EIDL loan and they have a UCC filing, how friendly will SBA be to subordinating that UCC filing?
Okay,
and
sure.
Going about that? Thank
sure,
you.
Of course, Hilda. So one thing the SBA is going to frown upon, and I like to talk about this having a little SBA person sitting on my shoulder when I'm writing these checks. So they don't want to see you expanding your business with these funds. The idea, economic injury disaster loan, it's based upon 2019 tax returns, top line gross receipts minus your cost of goods times 2. Okay, so it's trying to, in a backwards kind of way, trying to figure out what your fixed operating cost might be. And they're giving you 24 months worth of use, in essence, 2 years worth of funds in order to cover those monthly scheduled obligations. Well, they don't want you to go out and buy a building with it. Okay, so that's not the intent. There's, of course, interpretation in some gray areas, a lot of discussion behind, well, am I going to buy, what if I buy a couple delivery vans? Again, you have to look at it. Do you have existing delivery vans now that you're selling and replacing? So because we have seen instances where we could replace equipment, we could replace some items. We know we can use the economic injury disaster loan to purchase inventory. So where I think it draws a line, as Hilda's alluding to here, it's going out and buying a building. You have to be, more strategic than that, than just to try and use the idle funds in that way. And then the other part of this, like we're talking about, is whether it's going to be subordinated or how the SBA. So we know the SBA is creating a whole division. They have an email address now. They have a team that's going to be around this whole notion of subordination, because those loans over 200,000, one, we're going to have a personal guarantee that comes into play. So we got to understand that. I was talking about earlier about these at certain loan amounts, things change. Well, 25,000, then we have 200,000. At 200,000, now we're going to sign a personal guarantee. At 500,000, so now the loan amounts have gone up. There's a whole history lesson here behind that. Like it was 2 million, then it dropped to 150, then it went to 500. Well, guess what? Now we're back up to 2 million today. So today's the day that the SBA is now going to review loan applications for up to $2 million through the Economic Injury Disaster Loan Program. Well, over 500,000, if your business has existing property, they're going to want to take collateral on that, right? They're going to have you sign off on that. They're going to go even deeper, and they're going to look at your personal asset statement. Okay, they're going to ask for, I believe it's a 625 on the credit score over 500,000. And they are going to review your ability to repay over loans of 500,000. So it changes the game, and people are catching on to it. So maybe they take a loan $499,999, right, to avoid all the extra scrutiny that goes into the loans at over 500,000. But I tell you, folks, to have access to $2 million possibly at no fees, right, no broker costs. I'm a licensed broker, so I can say that because it's amazing. And 30-year amortization, 3.75%. And get this, nonprofits at 2.75%. Right? Whenever have nonprofits been had access to Fed money like this on a loan? So really interesting opportunity to be part of the Economic Injury Disaster Loan Program. It's about a 20-minute application if you're coming into it new. I highly recommend that you at least go through the process. If you were in business in 2019, if you file 2019 tax returns, because that's what it's going to take, and you have to be able to state that your business has been adversely affected by COVID in some meaningful way, or the other way to think about it is because of continued uncertainty, I'm in a position where my business could utilize these funds. All right, so you need to be able to say yes to something like that. Now, there's no math behind it. Okay, so I don't have to prove 25% top line reduction or anything like that. It really is, has my business been adversely affected by COVID or because of continued uncertainty, which I think a lot of us, unfortunately, we can say yes to. This is a great opportunity to tap into the Economic Injury Disaster Loan.
Now, Craig, let
yes,
me
ma'am.
ask a question. What about a business owner who's a developer? And their business has been impacted. They can't get some restaurants opened up because of sites that they're developing. Can they apply for this program?
Probably not. There is some restrictions on some of those folks. Folks in the financial space. If you file, I'm always. On these types of programs, I'm always file and let them say no, quite honestly. Okay. I think I wouldn't tell anybody no. Even if you're selling marijuana paraphernalia, maybe there's a subset or something, or the way your business is structured, it's outside of that scope of business. I really am of the advice on something like this to apply and let them say no. I'll tell you why, because I have the rules keep changing. As far as qualification and how they interpret the rules, like the affiliation rules have changed to now 500 employees per location, right? That was a big change, right? So now suddenly it opened it up to bigger companies to have access to the economic injury disaster loan. So that was a change. We've seen some wiggle room on independents that have real estate, like as far as using a Schedule E to try and figure out if there's a loss in rental income. So there is a whole separate math calculation to figure out if you have rental properties. So maybe a developer has in their portfolio, other types of rental properties or something. The issue with developers typically is it's a lot of their revenue, whether it gets pushed to future, and what the economic injury disaster loan didn't account for was future revenues. And so it really was all about the 2019 tax return. So I don't know if you have anything else to add from that in your experience of what you've heard, but that would be my advice for those folks in that particular industry.
Well, I certainly like what you said, why not? It takes 15 minutes to go through the process, try it and see if that works, because they have really opened up the bandwidth of the program. The other thing that we're getting questions on in the chat is, again, could you hit on one more time, Craig? I don't think that answer was clear. Mm-hmm. What happens for the business owner who does get a loan over $500,000? They file a UCC filing, and down the line, they need to get some additional capital or a line of credit. Will the SBA in a more expeditious fashion?
I don't know if it's gonna be expeditious. That's a big concern. I know it. So Hilda, I know it's a concern for a lot of folks, what that process is gonna look like. Listen, there's over 4 million people that are gonna have this loan. How many are gonna have over 500,000 where we have a lien or collateralization of the business real estate, and they're trying to refi? All I've been told, and you won't see it anywhere in the interim final rules, is that they have an email address now. They have a group of folks who are going to be dedicated to servicing just that question there about subordination. And everything I'm getting from the SBA district office is that they're going to be it's going to be very favorable for them, that they're in a position where they will subordinate and sign off and move the deal forward. They don't want to be in that position, because what's interesting about the economic injury disaster loan from a collateralization standpoint is that if you read the EIDL docs, for the most part, it's very vague, all encompassing, that they don't attach themselves to something particular until we get over 500,000. And all the feedback that I'm getting from district office is that they don't want to be in the business of stopping something because of their lien position. They're willing to go, with whatever, in essence, what the new bank would decide, or however they're trying to refinance, or whatever they're trying to do. I know it's not going to make anybody feel any better about it, because that's a reality that we're going to have to face.
Oh, that's a fair answer. That's a very fair answer. I mean, SBA in each of its programs shares that they're not trying to impede in any way a small business owner from growing. Now, how long that's going to take, we always answer, it depends. And we don't know. It is the federal government. It is a lot of loans. But the goal is to try and ensure that a small business is not hampered from growing.
Yep. Agreed, 100%. I wish we had more for you, Mark, on that. It's a risk. I understand it. But for me, the cost of the money itself, I got to weigh that in. No points, no fees, 30-year amortization, 3.75%, right? There's some cost on that. And I see there's a question in there about the documentation about how the EIDL funds are used. So here's, part of the other cost of the EIDL funds themselves. Like if you go deep into your EIDL docs, which you should, right? Here's your whole piece about collateralization. There is a whole line in here about books and records and about maintaining your books and what that's supposed to look like. Such as like this one right here, not later than 3 months following the expiration of the borrower's fiscal year, we're supposed to be providing financial documentation. I haven't seen it yet. I haven't seen the SBA reach out for folks on this piece yet, but it is in there. And my recommendation is a simple Excel sheet or use QuickBooks or whatever. You're going to earmark certain invoices or rent or however you're going to use it, those funds that I used my EIDL to pay. Again, there's no timeline in which to spend the EIDL funds. So I don't know, I pick something that's reoccurring every month and earmark that as my EIDL or a whole handful of monthly obligations that I can just earmark as EIDL expenses. You can have your outside bucket of cash that you're generating revenue on, right? Okay, and I can use those funds for expansion. So this is what it really does from a strategy standpoint, right? It frees up my other revenue cash to do other things with. Now we start talking about expansion. We start talking about other things. If you had other free cash to do it, I'm using EIDL funds on a monthly structured basis that I'm keeping track of. And then I have my other revenue. So where it gets tricky is if you're not generating revenue, if you weren't able to pivot, if you're still having a hard time to get by day, then it'd be hard to justify any sort of growth or expansion. But yes, there are some books and records pieces in here. I am seeing the SBA ask for hazard insurance. So this one, I am seeing attorneys reaching out on behalf of the SBA. So I get some frantic calls and emails from folks. Why is an SBA attorney calling me? This is why, okay, they want to see the hazard insurance. And then they also want a solution. Okay, this is the other piece. They call it the P022. And really, it was just a statement of fact that you got together with your board and made a decision to take out debt. What confuses people is this line right here. It's a not to exceed, so you can put a much larger number in here. Some folks were putting in what their original loan amount was, and then they were filing for the increase. I mean, we haven't gotten into file. Well, people would file for their increase of the EIDL, and the attorney would come back and say, wait a minute, your board of directors only approved a loan of $50,000. Now you're asking for $150,000. Now I need a new board of directors resolution. Okay. And we're gonna have to file new legal docs to get to, it really is just signatures. If you're a sole prop, you sign it, you stare at yourself in the mirror and you talk about how you'd use the funds. But it is a document that the attorneys are asking for the hazard insurance. And what we're seeing is the resolution. The resolution is actually becoming part of the increase request is what we're seeing. They're finally being preemptive and getting some of this information up front instead of trying to come back around 18 months later to get this information. So really unique loan. Highly recommend folks at least take a look at it and entertain it. You can always say no.
And Craig, why don't you, if you would, because Jason had a question about that increase, can you take time and just talk about that?
Yes.
I got an EIDL loan for $150,000. I want to do the increase. Will they re-amortize me? Will it go back? Will my $150,000 plus my new be 24 months? How will that work?
So it's a loan modification is what it actually is. So they actually modify your doc.
Well, it looks like something happened with Craig. I could see that his Wi-Fi was getting a little rickety. Let me see if he's going to be able to log back in and get back on so we can try and make sure other questions get answered. What I do know about your question, Jason, is yes, it's a loan modification. If you've already gotten an EIDL loan and you're getting and you want to increase your EIDL loan amount, they will do a modification of your loan. And your amortization will be 30 years. Your monthly payment due would be over 24 months. And that will start at the time that your new loan is funded. So I've been on some webinars where that question has been asked and answered. And so you can expect that if you want to do a modification, and the reason we wanted to bring this webinar today and we didn't want to delay is because we are assuming these funds are going to run out fast. In fact, today was the first day that they opened up the program to go up to $2 million. You could go up to $500,000 prior to today, but after today, it went up from $500,000 to $2 million in availability of what you could get in terms of the EIDL loan. So it's a really great opportunity for you to be able to apply for this loan program. And what we will do, if Craig is not able to log back on, we're going to be sending you out all of the slides associated with the program. When he says that the program is, applying for the program is easy, going on the EIDL website, completing those first 4 or 5 screens where you're answering those questions. Then what happens after you complete those screens, you're going to be sent an email, and that email is the most critical. When you receive that email, that's where the work starts, where they will grab your information. They're going to ask you to complete a 4506T tax transcript form. That's a form that you completed, many of you, when you got your SBA 504 loan, but they created a special 4506T just for this program so that SBA can expedite pulling the tax transcript for your 2019 tax year. They could ask you to also submit your 2019 tax returns. But once you get that email, look out for that email, look in your spam, make sure you get that email, because they won't start working on your application until you return and establish a new login for that. And if you're looking to do an increase, you will have to go in through that your existing portal. And if you don't know what that is, when you go on the SBA website, there's a section that says, I have an existing EIDL loan, meaning that loan has been funded. You'll have a different path to go to be able to upload to get your modification of your EIDL loan. Again, I think this is a really great program. It does not look like Craig is able to log back on, but what you're going to be able to get from us is the information you're going to get a copy of this recording. You're going to get the PowerPoint slides that we covered on the 504 debt refinance and the tax credits. And you're also going to get the EIDL PowerPoint slides as well. And you'll get everyone's contact information who was on the webinar. We believe it's a great opportunity for you, our clients, to be able to finish strong and take advantage of these programs. And if there's anything that we can do, any questions that we can answer or handhold you through, we're more than willing to do that. We certainly have these relationships and we will use them on your behalf. So don't worry about that. It looks like Craig is logging back on. I know we're a little over time, but I'm going to let him at least
Kick me out. That's all right.
Yeah.
That's what happens when I talk too much. I know, it just kicks me out.
Craig, I tried to tell them about the increase. I know we're out of time because we gave them a window of time, but can you give some closing comments and what we can get from you to send to our clients? And then of course, we'll send your contact information as well.
Yeah, I'd say folks can reach out to me directly, no problem. I'll put my contact information in whatever chat, or you can share my contact information. It really is direct from the Fed, the COVID-19 relief.sba.gov. I would fill out the application. Again, there's no fees associated with it, so you're free to fill out the application with the Fed. They'll make a decision. You can still say no. or, if you have access to that capital, then we can really get a round strategy and how we can best utilize those funds. So that's my recommendation for you.
Thank you so much. Well, we really appreciate your time, Craig. We appreciate your time, Elsie. And thank you, AmPac team. You know that we're your frontline advocates to make sure that you as small business owners have great success. And as a partner of the SBA, any information that we can get for you, we're going to try and get to you as real time as possible. Don't hesitate to call us. Thank you again for being on, and we'll continue to share information real time as we get it. Have a great weekend, everyone. Thank you again for your time.